I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make this money. My job is not just to entertain, but to teach, educate, put this one in context. Call me, 1-800-743-CBC, or tweet me at Jim Cramer. A column of doom heads to encircle and snuff out a city filled with children, schools, universities, hospitals, and people want to live in a democratic society. A Fed chief heads to Capitol Hill to talk about lowering the boom on an economy that's become too hot to handle, rampant inflation, oil soaring off the charts. This combination of doom and boom naturally produces gloom. And that's what drove today's action. Dow plummeting 598 points, S&P plunging 1.55%, NASDAQ tumbling 1.59%. I want to stress that Wall Street's acting out of gloom, not panic, just a legitimate sense that things have gotten very off track and aren't going to get back on track anytime soon. I say, hold on. Why don't we step back for a moment and see what happens rather than taking action? When every headline about someone not selling phones or sneakers or credit cards to Russia. I get that attitude. It's only natural. As we're waiting for Fed Chief Jay Powell to explain patiently how the war in Europe won't slow down our economy enough to break inflation, the horrors in Ukraine make for a level of uncertainty that we haven't seen in ages, causing interest rates to plummet when normally they would be soaring. If anything, the skyrocketing price of oil, now north of $100 thanks to the Russian invasion, means we could be in a situation where higher gasoline actually creates its own demand destruction, having reached a level where people simply don't drive as much. This combination of negatives gives us a very confusing moment where inflation should be driving interest rates higher, but instead rates have plummeted because the events of Ukraine are so darn frightening that it's caused a fanatical flight to quality. The citizens of Kiev want to justifiably be hiding in the subway. The denizens of Wall Street, they want to hide in government bonds. Everybody's hiding. Is there any way out of this situation other than lower stock prices? I think that is the question of the moment. The glib answer is just to say, absolutely not. No, they have to fall. The only way for stocks to bottom here is if they keep going lower and reach a point where there are no more sellers. The logic, we're in a bear market. And as long as you're in a bear market, investors will sell until they run out of firepower, and only brain-dead bulls will stick around for the carnage. I certainly understand that kind of negativity. I've seen it a lot in my career. If you bought stocks today, you're buying ahead of a two-day session of Fed speak that will also drive stocks lower. You're buying ahead of a 40-mile Russian column that's ready to lay Kiev to waste, right? Although, fortunately, the Russians seem to be running out of fuel. Put it all together, it does make for an incredibly ugly moment. No one is disputing that. But on really hideous days, yes, I do like to play devil's advocate and tell you what I think could go right, not wrong. I will let everyone else do that, and they do it very well. First, domestically, it's entirely possible that Jay Powell goes before Congress and says he doesn't like how inflation is going, and he has to start the process of raising rates in order to tamp down skyrocketing prices. But he's a measured fellow, and he may take a measured approach, telling us that he'll hike once, then wait and see if he needs to do more. Powell can save 50 basis points or 25. What matters is that once he says he's going to do it, that issue's done. You can stick a fork in it. It will take the uncertainty off the table. If Powell says the rate hikes will be automatic and swift, then the market will absolutely get hammered. And that's what today's action was forecasting. They think he's going to revert to the way he was when he first started. I don't see him going there. Second, it's absolutely true that there is a column of destruction headed to Ukraine's capital. The Russians showed you both in Syria and Chechnya that their army is willing to take out anything and anyone, any civilians. It doesn't even matter if the civilians are on their own side, or those were much smaller operations against much weaker targets. It will be horrific when that column arrives and presumably encircles Kiev, but the West seems to be out of financial bullets that can restrain the Russians, and our stock market is going to trade based on atrocities. That said, a lot of us assumed this war would be over in a couple of days. The Ukrainians have acquitted themselves much better than anyone expected. In the end, they're still outmanned and outgunned, but the idea of Russian invincibility, that's been shattered. At this point, we don't know what kind of weapons Ukrainians have, more obviously coming from the West. Either the Russians will be repelled or Ukraine falls, and then Russia has to occupy a hostile nation. Those are not good outcomes for the Russian army. No matter what, the West will keep supplying arms. No matter what, Russian soldiers will keep dying. It's a terrible situation, but it doesn't have much bearing on the U.S. stock market unless Putin truly loses his mind and starts deploying tactical nuclear weapons out of frustration. That is the biggest fear right now among many people, and that this war does go nuclear. If Putin hits the red button, our stock market will collapse. That will be the least of your worries in a World War III scenario. If the battle remains just that, without nuclear weapons, then we have to presume that oil can keep going up, and that will have inevitable demand destruction, but of course lead to a lot of number cutting. But it can create a recession all by itself, as we saw during the oil embargo of '73. Lousy way to get the Fed off our backs, but it'll work. Now let me give you one other way out. Remember all that cash I always tell you to keep on the sidelines? Remember when we used to say that if stocks dropped a lot, they might be interesting, and that a combination of buybacks, dividends, superior earnings can transcend the chaos? I'm not talking about buying the dip, by the way. A dip is not down 30%, which is 30. So many stocks are. I actually think that the money can come back from the sidelines. I think the sellers will stop with the right risk reward. They will stop. The one that says, hey, once again, you make nothing in bonds, especially after this run, and you make something in stocks. Plus, the demand destruction from high oil prices reduces the supply chain woes for everything else, making the Fed's job easier. Remember, we're not talking about earnings. We're just making the Fed's job easier. Does that sound too rosy to you? You know, it's actually maybe the most likely outcome. At a certain time and place, it means there are buyers on the sidelines who will start putting their money to work, not because they're buying dips, but because there's no other way to get a return again. Of course, to get everything working, you need Putin to come to his senses, either because his generals, or probably more important, the Chinese, tell him to cool it. And you need oil to come down, the supply chain issues to diminish, grains to reverse, and the automakers to get their semiconductors while mortgage rates drop so homes are more affordable. And that's happening right now. In that scenario, it's hard to see how stocks don't go up. So when can that happen? Any day. We just don't know which one. That's why it's right to have some cash and put it to work slowly in a disciplined fashion on the way down, as we were attempting to do with my travel trust, which I urge you to follow by joining the CNBC Investing Club. Many bulletins today, not a lot of buys, still too early. Then you'll catch the proverbial bottom as opportunity at last triumphs over fear. Don't know when. We just don't know when. But the bottom line, we do know you're a fool if you think that things are only just now getting bad for the stock market and can only get much worse. It ain't a dip, people. It's been going down since November, thanks to this endless sell-off. But you know what? Maybe we're a lot closer to a bottom than a top. Bob in New York. Bob.